Hi everyone, welcome back to the Advanced Mortgage Solutions podcast. This podcast is put together by Scott Miller from Advanced Mortgage Solutions, who is the founder and owner, and he's our expert today. I'm Joel Sadler, your host. Today we're going to talk about building a new home and what are lending options. So Scott, who's our experienced advisor today, is over 20 years in the industry and his professional background in logistics, management and finance. So technical knowledge plus real world experience of owning property and helping hundreds of, possibly hundreds or thousands, Scott? Easily thousands of homeowners into their own home is magnificent. So, buckle up, be prepared for some good information today. Scott, there's so many nuances around building your home, particularly if you're a first home buyer. Let's start with that. Like if I really, really wanted to build my, home, what would my options be for lending and how does that side of things work compared to just going and bidding on a home or putting an offer on a home that's already existing,
Question. Look, there's two different ways to build. One is more the old fashioned way. It was called a construction loan. What would happen is you'd go out and you'd buy you'd buy a section for yourself, and then go out to say 4 or 5 builders and get some quotes and then pick on whose plan you like the most, and that might be derived also around cost. And then what would happen is through the build, you would get drawdowns come as the house was being built. So for example,
Right.
the house's slab was put down, the builder would put his hand out for a payment, up the walls would go, the roof would come on, then there'd be a hand out payment, waterproofing, internals, all through. And what would happen is over the time of the mortgage, you would find that it increases in repayments that have to be made as each payment to finish the build was being made by the bank. Yeah. The more modern way of doing it is something called a turnkey build. And this is where you negotiate a price for the completed build. You know what section and you know what's going to be built on there because that's what you've agreed to. A very small deposit is required up front, maybe 5 or 10%, depending on which builder you're talking to. And then there's no more repayments until the build is completed. The code of compliance is received from council to say that it's now ticked off and livable, and then your mortgage kicks in. Much more first home buyer friendly, the second option. Maybe a fraction more expensive, not a lot more expensive, but you've got to understand that the builder has to cover all the costs of materials and labor and all the things to build the house. They have to cover that cost through the build period, where under the more traditional way of building, they would get payments for the work that they'd done at certain points of the completion of the build. Like I explained.
I see what you mean. So by doing it the second way, the actual overall cost might be a bit higher because they have to factor in their lending to carry them through. Yeah.
What we have found is some builders that can't afford to do a turnkey might exaggerate those prices to scare people into doing the more traditional type of build. But when they get to a builder that does both, say, the construction type or the turnkey type, you can certainly do that back-to-back pricing and find that it's not that much more expensive. But the advantages are huge. The not paying for a mortgage while your house is being built is a godsend because a lot of people are renting at the same time. And now not only are they paying the rent, but they're having to pay a mortgage for a house they're not even living in yet. And that can become very expensive. So this is where this turnkey model certainly comes in. There's some other advantages that aren't as clear-cut. One would be that if, heaven forbid, the builder went under through the build, then you've only paid a small deposit up front. You know that it's going to be picked up by the master builder or a certified builder's guaranteed, but that can take months, right? That can take months until they put another builder in place to finish the first builder's job. Whereas if you're 3/4 through your build and then the builder goes under, for example, you might have hundreds of thousands of dollars already in a mortgage that you're paying in a house that's not being completed for months and months until they can find another builder to complete it. So it's sort of an advantage that not a lot of people think of, but there's a few more protections in place for that turnkey type of purchase rather than the construction loan. On affordability, there's also a difference. So with a construction loan, because the lenders are aware that in the fine print of the fixed price contract, there's something to say that this might go up by 10% in a fixed price contract. Well, hang on, what's going on here? Why call it a fixed price contract if then it can be changed? It most certainly can be changed. The banks are aware of this. So as part of their initial assessment, they will do a 10% overrun as part of the affordability to make sure that if there was an overrun, you could afford the overrun. It doesn't pre-approve you for an overrun. It just allows them to know that if it would happen, then they're covered themselves and know that the applicants wouldn't put into a position of financial hardship. Obviously, with a turnkey, you've already negotiated the price. So if materials or labour goes up significantly within the build, it's actually a problem the builder has to deal with, not the first home buyer or the purchaser of that house. So again, and with the assessment, there's no overrun on the assessment because the bank only gets involved with the build right at the end of the build when the house is completed and code of compliance has been issued. So 3 major advantages of having a turnkey build over a construction loan. Now, there.
Wow. And the other thing that rang in my ear, pretty strong was the deposit amount. You said between a 5 to 10% deposit required potentially to put down, as opposed to say, buying the land. Which seems
a lot of places, a lot of times they can only afford the 20% deposit just to buy the land, because for a land purchase, you have to have 20%, even though by the time the whole build is finished, it can be as little as 10%. So the bank would just take a wee bit of equity out of the section that you've purchased to finish the whole build. You've still got a mortgage to pay on a section that's not even started to be built yet. So again, if you're renting at the same time, it can turn out to be quite expensive.
Yeah. So it sounds in summary, your advice to anyone really, well, correct me if I'm wrong, but it sounds like the turnkey, if you're really adamant on building your home, whether it's first home or not, the turnkey option is definitely the easiest route to go. And be wary of the, I suppose, construction route where there's a whole lot more stress potentially and having to manage, builders and relationships and all that as well, which can add a lot of stress and grey hairs, excuse the pun, to the process. Would that be fair?
I'm not. Construction loans have their place. They certainly still do have their place, but particularly, the initial round of podcasts are around first home buyers more than anything else. So that's where we're sort of more focused at this stage. And first home buyers are generally more vulnerable. They don't. They've never paid a mortgage before. They haven't paid rates or insurance before. They've got no idea about maintenance costs. So to do a construction loan where there's ongoing costs through the build versus a turnkey, it would certainly be more first home buyer friendly to do the turnkey option rather than the construction loan option. I'm not saying don't do the construction loan option, but if for a first home buyer, it would certainly make the process a lot easier.
And through either, the turnkey build option, I imagine from the legal's point of view, it's quite simple, a lot simpler, where the construction loan does all of those things have to go past and signed off by lawyers and all that sort of stuff as well.
So
each time
with the turnkey, there is no progress payments, right? So we're not going to a bank and showing them the fixed price contract that they originally signed with the drawdown schedule on it. And some banks say, okay, so the drawdown for the roof on was $54,000. Why have we received a bill or an invoice for $56,500? What's happened? Why is it no? And the world comes to an end until you can sort of explain to the bank why there's actually a higher payment. Funnily enough, even a lower payment. So we use the same, 54,000 was expected, but you only get an invoice for 50. What's happened? Why is it only? The banks will easily sort of go into the same need for detail on an invoice that's lower than expected and higher than expected. So they just want to know, why is this change? A turnkey, there is no drawdown. You're waiting to the end, and then you buy the house for the agreed price that you agreed to right at the start of the process. So,
brilliant. Sounds a lot easier. And then, building a home to live in it yourself is one thing, which we've kind of covered off there. But if you were building one as a rental property, with whether it's your first,
see where you're heading with this, Joe. I see where you're heading with this. Look, deposit changes. Deposit amounts do change, and it comes down to the overall intention of why you're building. Owner occupied or rental. So with the owner occupied, you can go as little as a 10% deposit across the completed build price. Obviously, you can go more. The banks will always like more deposit, but you can go as little as 10. When you buy a rental that's existing, the banks now need to have a 30% deposit to buy a rental that's existing. But to encourage helping out, the housing crisis in New Zealand, the lack of housing compared to people looking for homes, the government came out with, if you build a rental, then they only need a 20% deposit. And that's to encourage new stock for people to be on the market to rent. So there's an advantage of building a rental because you only need a 20% deposit versus buying an existing rental where you need a 30% deposit. So really good point to make out. And again, it comes back to they don't mind how you build that. It could be a turnkey build, like we explained before, but you'd need a 20% deposit, or it could be a construction loan, you'd still only need a 20% deposit. But again, I'll say it one more time, if you're buying an existing property and turning it into a rental, then there's the expectation of a 30% deposit. So something out there for investors, and it's a good thing, I believe, because, investors also like the idea of having something that's brand new, because it means that their proposed maintenance costs for owning that property are probably going to be very low for the first 10 years of its age, to lower those kind of expenses. And that's what property investing is all about.
100%. And for those that are interested on the, rental property maintenance side of things, Scott spoke some really wise advice in a Property Investor podcast episode, which I think's 2 episodes before this, around the potentially being caught with older housing stock and like whole lot of maintenance issues that can crop up, where I suppose if you're building something, you can choose something where not only is it low maintenance because it's new, but the material will last longer than other materials.
Latest technology, warm in the winter, cool in the summer. You're going to get a higher rental return from a potential tenant because it's brand new. And like I was saying, it's a 20% deposit, not a 30% deposit. So, awesome, very good option out there.
Yeah. Okay, Scott, is there anything else that you can think of that you want to talk about, building your own home at the stage? Or
if you do go down the construction route, there's, out of all of the types of lending that banks give, building through a construction loan is probably the one that has the biggest variances between the lenders. So some lenders put a lot of hurdles in the way to build, which sort of indicates to me that they're not that keen on builds, where others make it a lot easier. So when you're talking to your mortgage advisor, ask them, hey, we are looking to build either through a construction loan or a turnkey, particularly on the construction side of things, what lenders may be perceived to have a product that would run more smoothly than others. Because there is quite a big difference between what the lenders offer out there. With the turnkey option, look, it's all pretty much the same, because as far as the banks are aware, they're just buying a house that already exists. You know what I mean? They don't get involved until it's all at the end. So it's just like buying an existing home for them. But the construction, there's quite a big difference between different lenders.
Yeah. Interesting. Awesome. All right, Scott. Look, if someone wants to get hold of you or your team for advice and help on a build, whether it's the first one or 10th one, what's the best way for them to reach out and get the process going?
Always, it's a bit of a sign-off for us now. We do sort of point towards the website. There's all sorts of tools on there, calculators on there, contact forms, first-time buyer forms. There's pages on how to build, the differences between construction loans and turnkeys. So, the number one point, go to advancedmortgagesolutions.co.nz, and it gives you the ability of contacting us as well when you've made your mind that you're ready to push the button.
Brilliant. All right, Scott, thank you. to all our listeners, we'll see you on the next episode, and have a great day. Thank you.